Hi everyone, this is Justine from Impero Property Solutions. So today I want to talk to you a little bit about how you can be tax efficient as a property investor. And I'm not talking about all the specific property taxes that you hear a lot about at the moment, but I'm talking about the three key UK taxes that probably impact us all at some point, no matter what we're doing. So that's having a look at becoming income tax efficient, capital gains tax efficient, and inheritance tax efficient. And as we go through these slides, there are two concepts that I really want to introduce you to. And they are quite simply that we never sell our investment properties. And also key is that as those properties go up in value, you increase your debt against them. So I'll come on and talk about those as we go through, but let's have a look first at how to be income tax efficient through our property portfolio. So let's have a look at an easy example. We have a great family buy-to-let property, a 3-bedroom property. It cost £100,000 and we have a £70,000 mortgage on it. And we're going to use the example of an interest-only mortgage at 4.5%. So as I've said before in some of my other videos, £100,000 in the areas that we specialise in, so the Midlands and the North, absolutely would get you a great property. And what you probably know as well is that right now you could get a buy-to-let mortgage for less than 4.5%, but we're going to keep it at 4.5 in this example because it's a really good way to stress test your numbers. So we know that a property in that kind of price range in those areas will get £650 a month rent. But obviously there's some costs that are associated with that. Our mortgage at 4.5%, that's going to cost us £262 a month. We're obviously going to have our maintenance costs, some building insurance, and we're not going to do it ourselves. We're going to get a letting agent to look after the property for us. So I've allowed 12% there, which is a pretty fair rate at the moment. So I've got my letting agent fees as well. But with all those put together, I'm going to get a net income of £210 from that property every month. So that's my profit, if you like. That's good cash flow, £210 a month. You should be happy with that. And so what's really key is that we keep the mortgages on those properties. And before we look at the next example, for us, our recommendation is that you don't pay off the mortgage on an investment property. Very different to what you might want to do with your own residential property. So it's a brilliant feeling to be mortgage free on your own home, but it's not tax efficient when you're looking at your property portfolio. So what I want to stress is try and see the mortgage on your property portfolio as good debt. It's good debt because somebody else is paying for it. Your tenants through their rent are paying for those mortgages. And of course, it's making you money. That £210 a month cash flow, that is a good return. So what happens if you ignore it completely? You think that's rubbish. You just want to pay off your mortgage. So let's have a look what difference that would make to the property. So here we go. I've still got my £100,000 property with my £70,000 mortgage. I'm still getting my £650 a month rent. However, I'm going to scrimp, I'm going to save, I'm going to get together the money to pay off that £70,000 mortgage. So my costs are there, but obviously I've got zero for my mortgage cost. So what does that do? Okay, so that means now with the extra money, I have £472 a month that I'm making on that property. The key issue there is, what does that do? If I'm a higher rate taxpayer, that is going to give me a £1,257 extra tax bill, income tax bill at the end of every year, because now I'm a 40% taxpayer, higher rate. So not only have I been taxed on my savings, but you can see there, I now have a huge income tax bill as well. So it's really, really income tax inefficient. So let's have a look at the different option of not paying off the mortgage. So There's two things you really need to consider here. Firstly is your property is going to increase in value. So you're going to get some equity growth in that property. And if you remember the 2 points I said at the beginning of this video, is you should refinance as the property goes up in value. The other key thing you must remember to do is to always put your rents up each year. Rents should go up 3 to 5% every year. You can be completely clear with your tenants up front that that is what will happen. And really, when you've got a great rental property, which is what you know you will have, such a small increase is highly unlikely to put tenants off and to make them move out. So with those two key things, you're getting increased rent. You can go back to the bank, refinance, and take additional funds out of the property as it goes up in value. So if you look at the same sort of examples, we've got the same property, we're putting our rent up. I'm using 3% here, so our rent's going up from 650 to 670 to 690, etc. We are refinancing the property, so my mortgage costs are going to go up a little bit as well, and I'm putting a little bit of inflation there on my maintenance and my buildings insurance, and obviously the letting agent fee would go up accordingly as well. But what that means is that my net income is remaining the same, so it is income tax efficient because I am not paying any more income tax on the one particular property. Obviously, the equity I'm taking out can go on to increase and fund the growing of the portfolio, but this individual property, I'm not paying any more tax on it, so it's obviously a much more efficient way to have the properties. So that was a little bit about income tax. Let's have a look at capital gains tax. So in the UK, what you find is that properties tend to double in value every 8 years. I'm using 15 years here. Again, I'm just trying to be conservative. So for example, £100,000 property, in 15 years it's doubled to £200,000, another 15 years it's gone to £400,000, and so on. So we'd have several options between going from 100 to £400,000. We could sell it at that point. If you do that though, you sell it, you have made a £300,000 capital gain and you are taxed accordingly. So the example I have here is for a higher rate taxpayer, a 40% taxpayer. So that's somebody who earns £50,000 or more a year. And capital gains tax is 28%. So in that instance, you would be hit with a whopping £84,000 to pay in capital gains tax. And actually, to be honest, even if you are a lower rate taxpayer, 20% taxpayer, capital gains tax is 18%. So it is still a pretty significant £54,000 that you would have to pay in capital gains tax. So it's still significant. The other option is obviously if you've been following the example and following what we recommend you do with property, so refinancing as the properties increase in value, is you would have mortgages on the properties to the value of £300,000 rather than selling them for £300,000. So the difference there is the person in the first example would have probably made about a £300,000 net gain. In the second example, though, you would have the £300,000 net gain through mortgages, which could have significantly financed a much bigger property portfolio. You still have the asset, and that is key. You still have the asset, so in another 15 years, it's worth 800,000. In another 15, 1.6 million, which kind of comes back to the first point we made. Why would you ever sell the property? Did you realise you can actually get a buy-to-let mortgage until you are 90 years old? And even if you're still going strong beyond that, you could change it over to commercial finance to keep hold of that property. So although you may not be seeing the benefit, it may ultimately be your family who sees the benefit of that continued growth. And ultimately, once you die, the capital gains tax is written off completely. So hence why we say never sell. You're only buying great buy-to-let properties. Why would you ever sell them? And say ultimately when you die, there is no capital gains to pay. So that brings me on to inheritance tax, because obviously that's what would be due in the timely moments of your demise. So let's have a look at inheritance tax. So at this point now, you have built up £1 million property portfolio. It sounds a lot when you say it like that, but you think of our modest £100,000 house that we started with, it's only 10 houses. It isn't that big a portfolio. So option one, you have your £1 million portfolio, you've paid it all off, you have no mortgage debt against it. Inheritance tax is 40%. So that is £400,000 that we presume your children will have to pay, and you only get 6 months in which to pay it. Or the other option is the £1 million portfolio. You have been adding the good debt. Remember, it's good debt because somebody else is paying for it, and it's making you money. So in the second option, you have your £1 million portfolio, but you have £750,000 of mortgage debt against it. The 40% inheritance tax is only paid on the actual equity that you own within the property. So it's only 40% tax on £250,000. So it's only £100,000 to pay. So there's still some inheritance tax to pay, but it's much more efficient, obviously, that you have the mortgage debt against it. It massively, reduces the amount of inheritance tax that you have to pay. So hopefully that told you a little bit about how to be tax efficient with those 3 UK taxes. I'll just show you a table which helps you see how a professional investor would take the money out of property. So if you just look at this, we start off with our £100,000 house. In this instance, we've got £75,000 mortgage against it. We put £25,000 equity into that property. But if you look as the properties go up in value, so property goes up 20%, you have a 20%, £120,000 that your house is now worth. You always keep your mortgage debt in the same proportion, so that's a £90,000 mortgage. There's £30,000 equity, and obviously when you remortgage, one mortgage gets paid off and another one is released to you, so you have £15,000 released to you at that point, and so on and so on. As you can see, property every time that I've used 20% as an example here. So the house value keeps going up. You remortgage each time, keeping the mortgage debts in the same proportion, and each time you remortgage, paid back to you, and that's when it's paid back, that extra is put straight into your bank account and it is tax free. So you are either probably initially using that money to increase your portfolio by further buy-to-let properties, or there is still the option when the portfolio is as big as you want it, it is earning you what you need, then that money is the money for you. That's your exotic holidays and your flash cars. So when your property portfolio has grown to where you want it, that is how you can, make our professional property investors make some serious money through their portfolio by releasing that cash back out to them. So it's really, they utilise 3 key things. That obviously they're using the equity that's always increasing in their properties because they're buying the right properties, they're making the right choices in the right places, so their equity keeps going up. Obviously, this is a really good example of that, the compound effect. So obviously, you start with a 20% increase on a £100,000 house, but then it's on 120, and then it's on 144, and so on and so on. So you've got fantastic compounding. And of course, the third one is when that equity is released back, it's tax-free. So 3 super efficient ways to get money out of the property portfolio. Obviously, do get in touch with us. We can talk you through this. We can talk you through this one-to-one, so you really sort of see how it all works. But we just thought it's a good example to. So I hope that's been really helpful. If you want to subscribe to this channel, we have got many more useful property videos, tips and information. Give us a call to find out more. Have a look at our website, see what we've been doing, and hopefully from today you've realised how we can be income tax efficient, capital gains tax efficient, and inheritance tax efficient. Thanks for listening.